This chart tracks the volume of Brent crude trading on the morning of March 23rd. At exactly 6:14 a.m., trading volume spiked to 9 times its normal level. $580 million in oil futures flooded the market, just 16 minutes before a major military announcement paused strikes on Iranian facilities. At that same timestamp, we see a correlated anomaly on digital prediction markets. Newly created accounts suddenly dropped hundreds of thousands of dollars on wagers, correctly calling for an imminent ceasefire. These timed bets capitalized on the volatility of the US-Israel-Iran conflict. As fighting threatened the Strait of Hormuz, a choke point for 20% of the world's oil, crude prices jumped to $126 a barrel. With the primary shipping artery effectively frozen, global supply chains suffered immediate shocks, leaving markets to operate in a sudden vacuum of reliable information. This dual crisis enabled 2 distinct forms of profiteering. While established industries extracted wealth from the physical disruption of global commodities, a new class of insiders used digital networks to cash in on exclusive information. This bar chart shows the impact on shipping costs. While rates for West African routes stayed flat, the cost to move cargo from the Middle East Gulf to East Asia surged 5-fold. Simultaneously, marine insurers raised war risk premiums from 0.25% to as high as 10% of a vessel's total value. Major energy producers, Saudi Aramco and Total Energies, avoided the maritime bottleneck by rerouting supply through massive inland pipelines. This allowed them to maintain full export capacity while selling their oil at inflated global prices. Those logistical shifts translated into immediate gains, with Saudi Aramco reporting a 25% jump in quarterly profits to $32.5 billion. While energy firms captured immediate cash, defense contractors locked in long-term margins. As munition stockpiles dwindled, government orders pushed the backlogs for firms like Northrop Grumman to a record $95.6 billion. This volatility funneled billions into Wall Street's trading desks. In the first 3 months of the conflict, the 6 largest U.S. investment banks generated a combined $48 billion in profit. Traditional war profiteering relies on this model, leveraging physical supply and demand within a heavily regulated financial and institutional framework. A parallel economy has emerged on unregulated prediction platforms like Polymarket and Kalshi. Here, speculators bypass commodities and bet directly on the outcomes of military operations. A Yale University study analyzed the trading patterns on these platforms during the conflict, identifying a cluster of suspicious accounts that secured $143 million in profits. This scatterplot shows the anomaly. While average users hover near a 50-50 win rate, a specific cluster of accounts won nearly 70% of their bets across 200,000 cases. Researchers describe this as a statistical impossibility without the use of insider information. To keep the platform liquid while insiders siphoned millions, Polymarket relied on aggressive marketing. A recent Wall Street Journal investigation revealed the company paid influencers to target retail users with deceptive content. Influencers posted over 100 TikTok videos showing users winning up to $1.9 million. However, these videos featured phony trades executed on dummy sites designed to look like the actual Polymarket platform. Polymarket's actual order books told a different story. For the exact bets promoted as winners in these videos, dozens of real user accounts had placed identical wagers and lost everything. By using the illusion of geopolitical engagement, these platforms lure retail speculators into a digital environment where the results are systemically rigged by those with prior knowledge. Traditional exchanges answer to strict federal oversight, but offshore prediction platforms operate in regulatory gray areas. These sites often lack the transparency requirements that govern standard financial markets. This lack of transparency has already led to legal consequences. In 2022, regulators banned Polymarket from operating in the U.S. for running an unregistered options exchange. The use of dummy sites for marking also places the platform in the crosshairs of the FTC, which requires all promotional content to be truthful and backed by evidence. Industry competitors argue that the primary function of a regulated exchange is to maintain auditable settlement records, ensuring the market cannot be manipulated behind closed doors. Wealth transferred during conflict now flows through digital data and predictive algorithms as directly as it moves through physical oil pipelines. If regulators cannot govern this new form of digital speculation, future geopolitical wealth will bypass traditional industry entirely, flowing straight to unregulated insiders.